Hi, folks. Mark Weissy here, and today we have the distinct pleasure of having my friend and fellow investor, Jesse Khera, on the line. So we're going to be talking today with Jesse about some of his history, how he got into the business, as well as what his firm, YieldWink, is up to today. So maybe that's a good spot to start, Jesse. Who is YieldWink? What do you all do? And what does the firm look like today?
Absolutely, man. In short, YieldWink, we're an online platform, and all that we do in simple terms is we connect investors to private investment offerings across real estate, private equity, and hopefully soon private credit. So some examples are multifamily properties, hotel developments, passively investing in businesses. For example, we have a joint venture partnership with Gregory's Coffee. We're now starting to look at some quick service restaurants, mostly on the boring business side. We're not really doing much venture capital on the private equity side.
Wow, full array of different asset classes there. Super interesting as I follow your story to see all the different investments that you guys are involved with. But I want to take a step back and talk a little bit about your story. Where do you come from? How did you get into the business? What kind of attracted you to commercial real estate and business investment in the first place?
Yeah, great question, man. I feel that my last, call it 10, 15 years really set me up for this stage on embarking on this journey. So student of economics, started working with a financial services firm out of Atlanta, Georgia. After about a year and a half, I was recruited by a mutual fund firm out of Jersey City, New Jersey. They managed about 200 billion at the time, and they brought me on as an advisor consultant. So my whole role essentially was to advise financial advisors working with Wirehouse, Morgan Stanley, UBS, you name it, probably cover them, assisting them on and educating them on mutual funds, ETFs, fixed income, equities, et cetera, right? So really away from kind of the alternative private market space. I believe it was about my second year there where I was tapped and recruited by a boutique private credit firm out of Midtown Manhattan. And they initially had me move out to cover the Midwest territory. So I covered financial advisors across 5 states, Dakotas, Iowa, Nebraska, Minnesota. After my first year and a half there, I was recruited to cover the New York City territory. So the term they kind of call us in the space is a financial wholesaler. Essentially, all that it means is we go around, we meet with these financial advisors, educate them on our solutions, in hopes that perhaps they introduce it to their end clients, right? What that allowed me to do is, because I was competing with so many other firms, it was really incumbent on me to, hey, let me go back home. Let me read through their PPM agreements. Let me learn what they're offering. Maybe I can start splitting some differentiators in what we do versus what they do. I think that's what really kind of opened my eyes to the private investing space. When you read through a PPM agreement, there's a lot that you learn. As far as I think most important to investors is really how fees are calculated, right? So some people will charge fees on actual invested capital. Some sponsors will charge fees even on the leverage that they're utilizing. So you kind of get to learn the tricks of the trade. And in my experience with financial advisors, I think 99.9% are very prudent. I think they do well by their investors. But then you have some advisors that kind of love the fees on fees, right? Where the sponsors are already charging their asset management fees, their fund fees. And then the advisor for placing the investor into the fund, they're also charging their own placement fee, which can be 1% to 3%. So that's kind of where I determined is, hey, is there a way where we could cut out the intermediary? Can we give direct access to investors on an online platform and really just mitigate or completely just do away with kind of that fees on fee structure? And that's literally the reason why I launched YieldWink. It's, hey, we can give you direct access to our offerings, no fees on fee structure.
Wow, that's amazing, man. And that's a true entrepreneurial story. You saw a problem or a need in the marketplace, and then you developed a firm around really solving that problem. So that's amazing to hear. And the best part is the investors are benefiting. And seeing your guys' growth, it's clear that value proposition is there. So great job. In terms of building YieldWink, how did that start out? How did you get into it? Were you investing before starting Yield? What was the genesis of the firm?
Yeah, I think like yourself in real estate. So when I was out in Minnesota, that's where I kind of house hacked my first fourplex. Fortunately, throughout high school, I used to work as a handyman with another union labor gentleman. So he kind of taught me everything with the trade, tiling, drywalling, putting up studs, 2x4s, et cetera. So I lived in one of the units, renovated it myself. At that point, the other 3 units were really just covering my mortgage plus a little cash flow on the side. Just got me addicted. I house hacked the first one. It's, hey, what else? So ended up buying another condominium down the street, and that just kind of led to the growth spurt. From there, it was just anything I could get my eyes on. The math made sense. I'm all in. So had that real estate experience, and where I kind of at that point understood, here are my strengths, here are my weaknesses. I think sales was a great strength of mine. Underwriting was becoming a great strength of mine. I've always kind of had that analytical background. But areas I didn't know, I would just go out, find an advisor, find a consultant, or just find a great joint venture partner. So that's kind of how we ended up landing in hotel developments and QSR.
Yeah, that's a great dovetail there. So, for any deficiencies that you had, you found somebody that could kind of fill that void, and then you leaned into your strengths. I think that's a common story in successful companies, and more specifically in real estate, is the need for teamwork and people to kind of supplant any kind of weaknesses you have, and then allow you to free up your time for operating your zone of genius. So that's a great story. Now, in terms of meeting your partner, I know you have a partner there who has a pretty illustrious background in food and beverage. What was that like? How did you identify your partner? What did they bring to the table? I would just love to hear more about that.
Yeah. So initially, when I launched YieldWink, I think I was maybe about 31 at the time. So I had some funds saved up, but of course, not enough to take on 15, $20 million deals, right? So I knew I needed a great capital partner, but at the same time, I also needed a good operating partner, someone who understood the space. So the gentleman that I met, who's now my partner, the minute I knew that this gentleman is going to be my partner is actually after the second referral that I received. So maybe about 4 years ago, a local gentleman that I'm good friends with, also a real estate sponsor, he mentioned, hey, you should meet this gentleman. His name is Vinod. He's like, you should meet Vinod. He's also in the real estate space. He's in Long Island. You're obviously in Astoria. I think it might be good for you guys to meet. So we all three of us met up over breakfast, had a great conversation. Like everything else, it just kind of fizzled out over time. Maybe about a year or a year and a half later, another buddy of mine, he was a CFO at a hedge fund here in New York City. And he said, hey, man, like there's this other guy that I know. He does real estate. He's developing hotels here in the city. He's done KFCs, et cetera. I think it might be a good marriage. So I said, sure, set up the meeting. Let's do it. And we meet up at this Mexican restaurant in Roslyn, Long Island. And lo and behold, it's Vinod again. So I think we both looked at each other and laughed, and we both at that minute knew, hey, this is the second time somebody's referring us. There's probably something here. So the way I structured it is I've always kind of been more the solopreneur type, but I knew that, hey, if you want to go fast, go alone. You want to go far, go with the team. So I understood that, and I wanted it to be kind of a fair package for both of us. So we discussed, what we did was we put him on a vested schedule, kind of a milestone / time vested schedule where, if X happens, Y happens, Z happens, you accrue X amount of additional equity in the company. And at this point, I mean, we've been partners for 3+ years. It's been going great. No complaints.
That is such an interesting way to get into partnership. And I feel like I learned something new hearing how you structured that partnership. I mean, I know we all kind of find partners we feel good about. Obviously, you do your vetting and everything like that. But I think most people start off by saying, okay, what do you want? What do I want? What do we each bring to the table? That kind of thing. Whereas I think the way that you approached it is actually maybe in some ways a better way of doing things, is attaching equity or whatever form of ownership you want to say to these different milestones. So kind of have somebody prove that they are part of this, that they're, so to speak, in the company, in the future of the company. So I love that you did that. And I'll be talking to you offline about how you structured that a little bit more specifically. In terms of where YieldWink is today, where are you guys today? I know you mentioned a little bit in terms of the asset classes that you're in, but what are the types of projects that you're looking at today?
Yeah, we've started off as a bootstrap company. That was a very conscious decision. The way I kind of looked at it, I look at some of the competitors. It's what really gets them in trouble is raising all this capital. Now you have people you have to answer to. And sometimes you're kind of forced to take on deals that maybe perhaps otherwise you would not have taken on. And the reason you have to take on deals is for the fees, right? If you have investors, you have to pay back. If you have to meet certain performance metrics, you may have to take on deals that you otherwise would not. We never wanted to be in that position. So we decided, hey, let's bootstrap this. Do we need to spend $100,000 on marketing the first 2 years? We probably don't. So that's kind of how we started YieldWink. We're still kind of in that bootstrap phase. Fortunately, we're a positive cash flowing company today. The way we take on deals, I think, is a bit different from perhaps some of the competitors, many others within the space. We try not to follow the crowd, right? Anytime I kind of hear, hey, Arizona's a hot spot, right? I mean, everyone was screaming Phoenix, Arizona, and Dallas, Texas. Everything that we do is data driven. We look at every single piece of data. We look at median incomes, population increases. We look at rent to median income ratios, literally everything you can imagine. We try to factor in, including geography. So right off the bat, we decided, hey, that's probably not a target market area for us, especially now where valuations we're at all-time highs. I think there was a lot of vintage risk involved. It's okay, if you're buying at the high and your exit is planned for 5 years from now, what are the chances you're really going to sell higher than this current price if rents are already stabilized? So instead, what we did is we went out and we said, hey, we're going direct to direct to seller. We cold calling campaigns, yellow letter campaigns to their property, to their house. We would download lists, we would buy lists, we would do our own kind of underwriting. Okay, if this gentleman has 20 units here, we'll go on rentometer.com, Zillow, we'll figure out what are the average rents in that area, and we'll throw on a cap rate that's a bit higher than the current interest rate market. So that's how we would start. Our differentiator was, hey, we went in with the offer. It's not, hey, I get cold calls all the time. Hey, are you interested in selling your property? And I'm like, shoot, what's your number? Oh, well, let me connect you with my vice president. I'm hanging up, right? So I think that was a huge win for us. We were able to lock down our first 2 properties that way. Fortunately, the second property, Richmond, Virginia, we got at a huge discount. They were going through kind of a litigation, the 2 partners with each other. So it was a win-win situation for the both of us. Where we are today, continuing to expand in real estate. As you know, we just took down a deep value add in Richmond, Virginia, 48 units. But we're starting to diversify into, let's call it, boring businesses as well. So we formed our joint venture partnership with Gregory's Coffee. We're now 50-50 partners on 5 stores. And most recently, under LOI, we have 12 Burger Kings in the Virginia, Norfolk, Richmond market as well. The reason we're doing that is, especially with quick service restaurants like Pizza Hut, Burger King, McDonald's, I believe that they're very cyclical, right? If you were in Pizza Hut maybe 4 or 5 years ago, it was a home run. Today, maybe not. But what I specifically liked about Burger King is, one, I noticed they recruited Pat Doyle, who was the CEO of Domino's, and fantastic turnaround that he did. Second, they ended up buying the Khera Group, which is one of their largest franchisees. So billion-plus acquisition of that. It showed that they had skin in the game. Thereafter, I started realizing that Burger King is not allowing just anybody to become a franchisee. Honestly, I went through about 10 interviews with the entire Burger King team before we were conditionally approved to even become a franchisee. They want young blood in the business. At the same time, a lot of baby boomers are retiring. So it's becoming very difficult for baby boomers to sell because there are no buyers on the other end because of how stringent Burger King is getting with allowing new franchisees in. So we looked at that as a win-win for us. We came in, we're actually locking these in at about a 3.5 EBITDA multiple. Whereas you look at 2-3 years ago, they go for maybe 5 to 6 multiple. So it's a huge win for us on the cash yield for the investor, IRR for the investor.
Very interesting, man. Yeah, again, a diverse set of different businesses. Now, in terms of how you look at them, well, I'll first say this. It seems like your strategy has been from the start, everybody's going left, you tend to look right or tend to question the popular consensus, which makes sense given your market background. That's kind of the whole crux of value investing, is when the entire market consensus is one thing, kind of looking, okay, what may be the market, what may the market be missing? So that's really interesting to hear. In terms of how you look at these businesses versus multifamily, which I think of multifamily as a business, as an operating business after all, but how do you look at them differently than maybe multifamily? Is it more management intensive? Are there more systems, things like that? I'd love to hear more about the differentiation.
I think the way we approach anything is with the same philosophy. We are looking for value add. We're looking for deep value add. So I'll give you a great example of the 2 different packages that we're considering. One is 5 stores, one is 7 stores with Burger King, right? You walk into the 5 store, that's more of a turnaround where employees are wearing their uniforms, clean uniforms. The kitchen is very clean. The floor is very clean. Everything is up to par. There's no deferred maintenance. When we look at the other package, I think there was maybe 1 employee actually wearing their Burger King shirt, their polo collared shirt, wearing the Burger King hat. A lot of deferred maintenance there. So those are the things that make a difference as to your average unit volume on a per store basis. So fortunately, I have a great operating partner, and I think that's going to be the biggest key to it, right? If your background is not as quick service restaurants, you better find a partner who's been doing this for 10 plus years. Because me rolling up my sleeves and going in, not really knowing what to do, versus him going in, having 10 years of experience, he knows exactly what to do. So that's how we approach any type of business. We look at, okay, if these stabilized stores are doing, call it 1.4 million average unit volume per store, yet this market in Richmond is a better market. There's more traffic in the area, more pedestrian flow in the area. Why are they only doing 1.1? Then it comes down to the same thing in real estate, right? If you have a Class B property and everyone else around you is charging $1,100 per unit in rent, and your property is only charging $950 because of the deferred maintenance, well, we know what we have to do. We know we have to go in there, probably spend, $400,000 to $500,000 in CapEx. Let's improve every unit, throw in $6,000 to $9,000 per unit, and let's raise the rents to about 1150, 1200, whatever the market could demand. So even if we're in any market, really, I think we are value add investors. That's kind of how we do it. To your prior point, I think there's an unwritten kind of rule in finance, and I learned this at the first mutual fund firm that I worked with. It's you're allowed to be wrong if everyone else is wrong, right? So if Morgan Stanley, Goldman Sachs, Apollo, they're all putting out their annual forecasts, and they're all kind of somehow in line with each other and they're all wrong, it's not a big deal. But if you're that one firm that takes the chance, you're the contrarian and you end up wrong, the way finance just looks at it as a whole is people are going to remember that. So I've always been of the belief that, hey, I don't care if I'm wrong. Well, of course you care if you're wrong, right? But I think it's incumbent on me for the investor to do what I think the data tells us to do, not just follow the leader in the space. And that's what we try to do.
Yeah, that much is clear. So you're basically these parts of the businesses that are maybe underutilized or there's opportunity to increase value, and then the execution side, you're partnering with folks who come from that world or who have expertise there. If it's not yourself, then you're finding somebody that can kind of fill those voids. That's really, really cool. In terms of looking forward for YieldWink, what does the next year, next 3 years, what is the long-term trajectory of YieldWink? What's your vision for the company?
Yeah, we're in talks to purchase a financial advisory firm. So we're looking to purchase an RIA. I have another great buddy of mine. He's a Forbes 5 advisor. We would want him to manage the funds for us. And I think our 3-year goal here is to also go out and purchase a broker dealer. And a broker dealer allows us to obviously solicit our own funds, but also allow to raise capital for other funds. So if we find great strategic partners, maybe Mark, you come to me and say, hey, I have a great storage deal. Perhaps we're not storage space operators. We'll underwrite the deal. If we like it, we'll allow you to market it on our platform as well. So that's kind of the longer term goal. But as of right now, any deal we put on the platform, obviously it's our names on it. We are the sole sponsors on the deal. If we do have co-GPs or co-GPs, we still have to be the lead on every deal that we do.
Understood. And for some companies that may be operating in a similar fashion, I know some of the things that they've run into is deals have gone bad that they've underwritten, that they've kind of put their stamp of approval on, and sometimes it hurts the brand value. So how do you get around that, I guess, as you start to offer maybe other people's deals on the platform?
Fantastic question. I'm glad you asked. The easy answer is to say it comes down to diligence, right? Would we do this deal ourselves? And as I alluded to before, I think a main reason why a lot of these sponsors, or I should say platforms, marketplace platforms, took on all these deals on their platform, that many of them, which didn't go so well, is in a way, they'll never say it, is in a way because they were forced to, right? When you're raising a lot of capital, you're taking on a lot of debt, there has to be revenue for your business. So I think the fact that we continue to bootstrap, we have absolutely zero debt on our balance sheet, that allows us to be extremely, extremely selective. So whereas maybe their pass rate was 5%, 10%, I don't know, our pass rate will likely be a lot lower because we're not forced to take on deals that we don't like.
I think that's the key, is not having your hand forced to have to make a deal work or pencil just to be able to justify having it on your platform. I know a lot of syndicators have run into similar issues where are eating off of the acquisition fees essentially. And so they have to do a certain number of deals per year to sustain their lifestyle. I think that becomes very problematic for a number of reasons. You're not aligned with the investors. So that's great to hear. In terms of looking forward now, how can folks get in touch with you? What do you want to, I guess, leave by saying to folks who may be listening and maybe thinking about getting involved in an alternative space, but doing so in a passive fashion?
Absolutely. I know that Americans are laggards in our utilization of alternatives, right? If you think about globally, correct me if I'm wrong, I think you may know this. Latin America is number one, followed by Asia, followed by Europe. Americans are the biggest laggards when it comes to alternatives. I believe the statistic is with all Americans, less than 5% actually utilize private investments, which I think is absolutely absurd. I think that alternative investments is the way to go. I think you have a lot more control on the deal, especially when you're doing deeper value add type of opportunities. And those are the types of deals that we offer. So anyone who wants to get in touch, learn more about us, visit our website, YieldWink.com. You can set up a meeting directly on our homepage. Even if you have general questions, just want more information, I'm happy to help.
For sure. Yeah, I know I have invested passively with YieldWink on a couple of their projects, and it's been awesome following your story along the way too, Jesse. I would say anybody who's interested in buying businesses, buying multifamily, getting to some of these assets with partners who know what they're doing, reach out to Jesse for sure. He's a wealth of information. So with that, we'll kind of sign off here, Jesse, as I always do at Maple Capital Partners. It's be kind, be charitable, and invest wisely. Thanks, everybody.